Hello, everyone. Tony Warfield here. I keep getting this question this month. So I literally, it's Friday, it's traffic. I just said, heck with it, I'm just going to pull over and see if I can put something together real quick to be able to explain why an IUL is such a powerful tool. This month I've actually, for my uh, personal production, I've actually had a record month because people are starting to get it, and I really am grateful to the veteran community and various nonprofits, churches or whatnot that give me the opportunity to do these presentations, these financial literacy workshops, because people are starting to get it. And as they understand more and more about the importance of life insurance, in particular, the difference between a term policy and a permanent policy, like an index universal policy, is a big deal. Now, I know that there's been some thoughts about why an IUL doesn't work, right? You get your share of ins and outs, but the reason why an IUL doesn't work is because the agents that are doing the IULs, they may not be teaching you how to properly fund an IUL. So what I'm hoping to do today is to explain the difference between the proper funding and not the proper funding. But I also want to throw something else in there because, I've had a few juvenile policies done, or, basically juvenile means a client that's under the age of 18, and your parent is taking care of the premiums, owning the policy, and making sure that, the policy is growing. But comparing the 529 college savings plan or any of those other college savings plans, I want to be able to show you the contrast between those and why the IUL could benefit you hugely. Now, I know that when you have a child, your baby's 1, 2, 3, 4, 5 years young, you want them to be able to go to college, maybe get a graduate degree, master's degree, or whatnot. So I wanted to be able to show you how that looked with an illustration. But let me see if I can share my screen. Let me see if I can find the page. So I want to show you what the 529 looks like, right? So they'll talk about, and understand, I advocate for the 529. If your children are going to college, I think the 529 is a fantastic tool to add to your portfolio. And depending on how soon you get started, you'll have a pretty decent amount of money in the account. And don't sleep on FAFSA or any of the other student aid programs, because you can let your child get student aid. The interest rate is really low, but you'll still be paying into something like some kind of a college fund that's going to be earning a higher compounding interest, so you can literally have your child graduate from college debt free. But let's talk about how that happens, right? So we look at this 529 chart here, and just what is this, school share? But a couple of things I wanted to point out. So this is predicated on a 6% annual return. You're putting about $100 in there, so that's like $1,200 a month, right? Compounding interest is 6%. But I'm going to read to you what it says here. Let me see. And this is important, and I hope you can appreciate where I'm coming from with this. So I hope you can see my screen here. It says, this chart assumes a $5,000 lump sum investment, a $100 monthly investment, and 6% annual return, right? Compounding annual. The calculations are for illustrative purposes only, as mine will be, and the results are not indicative of the performance of any investment. So that means that the money that you're putting in this account is going to be invested in some way, but that doesn't mean that where the money is being invested in is going to be profitable for your account, right? So the calculations do not reflect any plan fees or charges that may apply. So IUL is going to have some plan fees as well, but we're going to talk about those. If such fees or charges were taken into account, returns would have been lower. Such automatic investment plans do not assure a profit or protect against losses in declining markets. Account value in the investment options is not guaranteed and will fluctuate with market conditions. Now, when it comes to an IUL, the money that you're putting into an IUL, you understand that the premium that you're paying into it, a portion of it is going to the cost of insurance and a portion of it is going to the cash accumulation. The goal is to make sure you maximize the cash accumulation, especially when your child is young. Now, just like with this 529, it's subject to market fluctuation, but there are protections with the IUL that are not available for a 529 college plan, right? So what does that mean? So if you have $10,000 in the account and the market were to drop 25%, if the money is in your 529, you stand to lose about 25% of your money, right? But if you have an IUL, there's no market loss. There's no market risk. So I'm going to show you why this is significant. So let me stop sharing my screen one time. And I'm going to share it again because I don't know how to get that to switch back the right way, the way I want it to. Okay, so here we are. I'm going to show you an illustration. Now, those of you who are Eddie Murphy fans, and my favorite movie by Eddie Murphy is Boomerang. So if y'all remember this, this young lady here, let me see if I can highlight it. Lady Eloise, right? Marcus, darling. Yeah. Don't get me started. So anyway, I wanted to be able to show you what it looks like if you were to get a policy. Now, just like with the 529 college plan, it says you're going to start off with a $5,000 lump sum. Not everybody has $5,000 lump sum. Just saying, right? So say you don't have that, but you got a few $100, $100, whatever, right? So the reason why IULs do not work is this right here. So you can see that, Lady Eloise is the name. This is a young lady age 5. So, non-tobacco. That's probably going to be like the best option ever, right? The face amount is $200,000. And you see where I says option B switching to A at age 60, right? So what that means is you have an increasing death benefit, which is going to level off at age 60. Now the premium, you might be alarmed by this premium, right? And the premium is $335 a month. This is a max funded IUL. I say it again, it is a max funded IUL. Now, so to be clear, this is for a 5-year-old young lady that you want to go to college, potentially graduate school, or potentially get a master's degree or a doctorate, right? So let's take a look at why this is such a powerful option. First off, we have what is called the monthly no lapse premium. That means if you pay $20 on this account until your child turns 20, the policy will not lapse. 20 bucks, right? But I just told you that your premium is going to be $335. So if only 20 bucks is used to be able to go to basically cover the cost of insurance, what's going on with that other $315? Well, that other $315 or $215 or $115, whatever you pay over 20 bucks is going to the accumulating cash. That's overfunding, and with 335, it's max funding. Now, why did I choose 325 in particular? So you look at this number right here. So this is the guideline level premium. I'm not going to go through every number, but I want to talk about the guideline level premium. So you see this 4,055. That 4,055 is the amount of premium that you can pay into this life insurance policy and still be able to enjoy tax benefits, right? Tax protections. So anything more than $4,055.59, it becomes an investment tool, and the IRS will start taxing you against this policy. So if you want to be able to put more money in this account, you got to either raise the death benefit or get you another IUL. But this is the most that you can pay per year in this policy, even if the minimum per year in this case is about $20 a month. You're looking at, what is that, $240 a year? You pay that for 15 years. The policy is still in force. You got $200,000 worth of death benefit available. But if you're using the IUL to help you increase your cash accumulation potential, this is going to allow you to max out at $4,055. The majority of the money that's going into the IUL is going to the cash accumulation that's earning uninterrupted compounding interest. I want you to remember the uninterrupted compounding interest as we go through this conversation, right? So you have a few other things, with the life insurance, you have, living benefits, critical, chronic, terminal illness. If something happens to you, you get paid out while you're still alive. It's, you know, I hope nothing happens to you or your child. But if something happens, it's a whole lot more difficult to deal with challenges, health challenges, when you don't have money versus when you do. So living benefits is a really big deal. If your policy does not have living benefits, you need to give me a call so we can talk about seeing about getting you those living benefits. So one downside to an IUL is it does have limited indexes, right? So with the F&G IUL, you got Morgan Stanley, which does pretty well. Gold, BlackRock, Barclays, S&P 500, which is tried and true, Dow Jones, and then of course a fixed rate. Now that's going to matter to you shortly, right? But I want you to understand you don't want to put all your eggs in one basket. So when we sit down and we have a conversation about how we want to map out your illustration or how we want to map out your insurance, whether it be for protection, for the death benefit, you want to use it as a retirement funding, and in this case, potentially an additional resource for your baby girl or your baby boy to be able to go to college and graduate from college debt free. So you look at this mix, and this mix ends up showing you somewhere around 6.72%, which is highlighted here, right? So you can put more in the S&P, you can put more in Morgan Stanley. I just went ahead and with 25% on each one. So you see 25%, 25, 25, 25. You see the minimum look back for each of them. You see the maximum, and then you see the cap rate, 16% for gold, 11.5 for S&P 500. There's a spread for the Dow Jones, which means whatever the market is, subtract 3.25%. But the one thing that's important for you to know about every index in this IUL is the floor is 0.25%. So even if the market drops 25%, your money locks in at 0.25%. You don't lose any money. Now, you might be losing ground because inflation might be 3.2%, but you don't lose the numeric value of your account, which is fantastic. So let's go ahead and go a little bit further down. I wanted to be able to show you this. And of course, when I'm sitting down and I'm showing you this illustration, I'm showing you almost every page because I want you to understand everything. So on this particular screen, it shows you the performance of the various indexes over the past 20 years, right? So I hope you can see my screen here. So you see the Dow Jones, Barclays, Morgan Stanley, whatnot. BlackRock, we only got the past 16 years for them. But you'll see two columns in each section, right? So let's look at Morgan Stanley. So Morgan Stanley on the left side says Morgan Stanley U.S. Equity Allocator Index. The market in 2005 did 0.33. In 2008, that's when we had such a bad time, did about minus 20%. But the very next year, it jumped up to 21.86, right? But if you look at the column next to it, you're going to see where it says Morgan Stanley U.S. Equity Allocator. Sorry for the sirens. And I do live in LA. What do you expect? Well, I mean, what? Anyway, the allocator annual point to point 105%. So that's basically whatever the market is doing, you multiply that times 105%, that's going to be your return. So you see right here in 2008, where the market dropped almost 20%, your account locked in at 0.25%. The very next year, where the market did 21.86, you got 22.95, 21.86 times 105% equals 22.95% return. Not bad, right? So you look over here with BlackRock, they got 180%. So they did what 498 in 2009, and you got a return of 8.97. But you mess around and you look at what's happening recently, and you might see the BlackRock doing 11%. You might see Morgan Stanley doing 11%, and BlackRock not really performing well, and that's just basically locking you in at 0.25, right? But you're not losing any money. So if you got $100,000 in your account and the market's dropping 25%, you still got $100,000 in your account. When the market starts going back up, you start making more money. So let's take a look at the S&P, which has been pretty tried and true. They got an 11.5% cap, right? But look at what's happening with all these minuses. 2008, 40% minus. You locked in at a quarter percent. 2009, it went up 27.56. Yeah, you only got 11.5, but this is coming from a minus 40%. So depending on how the market is working, I'll put you in various indexes that's going to be able to perform to make sure you have some positive return every year on your money, or biannually, whichever index you whichever one you choose. Now you can see with gold, gold is a little different. So whenever the market is fluctuating downward, gold is usually pretty strong. It actually goes the opposite way. And even when the market is doing pretty well, gold is still doing some positive numbers, which is great, right? So you can see yourself maxed out at 16% here. And anytime the market is going down, you end up, just like with the other indexes, locking at 25%. Why is this important? Okay, so you want to be able to understand why this is important. So when we're going through the illustrations, and we could talk about the living benefits, but this is not a living benefits conversation. But just to throw that in there, if your account does not have critical illness, what is a critical illness? This rider covers heart attack, stroke, major organ transplant, paralysis, diagnosis of amyotrophic lateral sclerosis, arterial aneurysm, central nervous system tumors, significant burns, end-stage renal failure, diagnosis of invasive cancer, and sometimes cognitive decline. A terminal illness, if you're expected to expire within 12 to 24 months, you'll get a full acceleration of your money. Or a chronic illness, if you can't do 2 out of your 6 activities of daily living, you can't feed yourself, can't go to the bathroom, can't hold your stool, whatever, they'll be able to pay you out after about 90 days of this situation happening. But of course, we could talk about that in detail, but I really want to get to the meat of the conversation. So again, going back to page 2 of this illustration, I told you that the actual no lapse premium is for this policy for a 5-year-old is $20, but yet the premium that I'm showing being paid is $335. Why? Because you're using your IUL as a potential college funding income source, as well as a retirement source. So anything over that $20 bucks in those early years, life insurance is dirt cheap when your children are 5, 6, 7 years old. So the majority of the money that you're going to be putting in there is literally going to the cash accumulation that's going to be earning uninterrupted compounding interest. This is why the rich get ahead, right? So you take a look at this, right? You're going to see a whole bunch of numbers. Please excuse, I'm going to break this down for you so it's forever to be broke, right? So you got guaranteed assumptions. Now, how can a life insurance guarantee you a return? Because they're going to offer you a 0.25% floor. That means your money is never going to earn less than 0.25%, right? Now, the way that I got this structured is I have your child, in this case, Lady Eloise, you're going to be making the maximum premium payments until they graduate from college and grad school and all that other stuff at age 26 that you see here, right? So the last payment will be right here at age 26. Let me see if I can get that a little bit bigger there. So age 26, right? So you see at age 26, under the guaranteed assumptions column right here, you're looking at the original death benefit is $200,000, but this is an increasing death benefit. So you're going to be adding the account value to the death benefit, which makes you a total death benefit of $272,000. That's guaranteed. So what does that mean? You got $72,000 in this account, guaranteed. If the market were to tank and stay tanked from your child's 5th year to your child's 26 years, that's 20 plus years of the market never recovering, you still got $73,000 in the account. You never lose money. That's basically the money that you put in there, right? And then the very next year, I got it set up from where you're paying $335. You're going to switch the account, or you're going to switch ownership to your child, because now they're old enough, they got a job, they got some money, but you're not going to try to stress them out too much. So instead of max paying just $100 a month, but you gave them, look at the head start you gave them, right? Now this is what's powerful about this IUL, right? So I just told you that you're going to be paying until age 26 until they graduate from college. And you guaranteed to have about $72,000. In this illustration, you're guaranteed to have about $73,000 at age 26. They get a job at age 27, they can start taking over payments for their life insurance policy. Now they're 27, and this $73,000 can be used to pay off the student loans, or at least some of them. If the market never recovers, you can still pay off those student loans. Now, this is what's powerful about this. That $74,000 that you're looking at there, That's your money that you've been putting into that account. It's yours. So there's no tax implications on that. You can withdraw that money and suffer no tax consequence. Use that money to cover the cost of any education. Now, we talked about comparing this to the 529. The money that you accumulate in a 529 has to be used for college expenses. So what happens if you got this $74,000 and your child doesn't want to go to college? Not even interested. Do you have to use this money for college purposes? No. Your son or daughter might want to use that money to start a business. They might want to get married. They might want to travel around the world. You might want to just give it to them to be able to do whatever they want. You can do that. There's no limit to what you do with that money. Now, what's even better than that? Why not just leave the money alone? Why not just leave that $74,000 in the account and borrow against it? So now you're not withdrawing the money. If you don't withdraw the money and you leave the money in the account and you borrow against this money, you'll be borrowing money from the life insurance company using this $74,000 as collateral. So you can use that $74,000 as collateral to borrow money from the life insurance company at an interest rate that is at or below the interest that you will be earning on this money while it's in the account. And if something happens and you cannot pay that money back, it just gets deducted from the death benefit, and your beneficiary will be able to get the amount that's left over tax-free. So now let's look at this second column. The second column assumes a 4.5 fixed rate. So if you were to just get a fixed rate, and again, the last payment of $335 will be at age 60, at age 26, you're looking at about $129,000 available to your child when they graduate from college. If they at this age, if they did go to college, right? So you're looking at about $129,000, right? And if you look at the prediction that this illustration is showing you at a 6.72% return, and remember, unlike the 529, this is not a lump sum start. You started out with your monthly payment of $335, right? Or, okay, 335 is too expensive. I can only afford 250. I can only afford 150. I can only afford $100, right? Whatever it is, as long as it's more than a minimum payment, the additional funding is going to the accumulated cash. Now, that does affect the growth of the account, but if you max this out, look at the growth that you're getting. So let's go back to the age 27. You're looking at about $170,000, and then you're going to add that to the death benefit that's constantly growing. That's huge. This money is available to be used for whatever it is. And if you borrow against this, that money continues to earn uninterrupted compounding interest for as long as that money is in the account. And if you set it up properly, put it in a trust, now that money can be protected from probate or any other legalities a child might have. Now, I said that because you're going to be switching this over to your child, you lowered the premium from $335 to $100, which is about $1,200 a month. Even if that child only paid, or that grown person by this time, only paid $1,200 a year, I want you to look at the growth of this account. At age 36, $322,000 with an $806,000 death benefit. Age 46, $640,000 with a $1.4 million death benefit. I don't know what the retirement age is going to be, but they're still trying to find a way to let us die off before we get Social Security. So if we don't find a way to put some money away, we're going to get in trouble. So say your child is, you see right here in the far left column, age 50. They decide they want to retire at age 50. If this was perfect, right? The market was doing well on average, and you got about an average 6.72% return, and they decided they wanted to retire at age 50. Age 50, right? At age 50, I can't seem to highlight this, I'm sorry. Okay, at age 50, right? The guarantee, they still got $93,000 sitting in that account, right? At 4.5%, $409,000. Right? Your account value, if you're averaging 6.72, is $840,000. So my point being is even if the market is fluctuating like crazy, you never lose money. There's no risk. So your money is going to be anywhere between $93,000 to $840,000. And and if you look at the history of the market has always done well. Even on a down year, it's done pretty well. So you're looking at your child having $840,000 potentially, and $1.6 million in death benefit, huh? And you don't even have to take the money out. How is that going to help you with some additional income when you're getting ready to retire? And I got this stretched out to age 65, the last payment. So if you look at age 65 being the last payment, right? The guaranteed amount of money that you got highlighted here is $297,000. Not bad. 4.5%. Your 5-year-old is a millionaire, right? At age 65, right? And if you look at the 6.72 or the current market value, if we were to maintain that average, you're looking at what, $2.3 million with a death benefit of $2.8 million. This is just with starting out with a few $100 and letting your kid take over for a few $100 a year, right? And if it's earning uninterrupted compounding interest, meaning that you are not taking withdrawals out, this money can continue to grow and be available to your son or your daughter for retirement purposes, starting a business, being the private lender to help some other people out who want to start a business, marriages, anything that's going to promote your family and your financial future and your legacy for your family. It's there. Whereas a 529 is basically just for educational purposes. Your IUL, the money in your IUL, the money that you're accumulating in your IUL can be used for anything. That's the point that I wanted to make, right? So I'm hoping that you can appreciate and I'm going to just let this peruse a couple of times because somebody's getting ready to make some noise in the background over here. So I'm looking at doing this presentation a little bit more formal, having a little bit more information, because not everybody's situation is the same. I had a client call me up, their child was 14, right? And they had not even a cent of money saved up. But don't sleep on on FAFSA, right? Because and remember, if FAFSA is charging you 2 or 3% and you're earning 6% on your IUL, go ahead and let your child go ahead and let them get that student loan, right? And then just pay it off when they graduate from college using the money that you accumulated in your IUL. And you still have insurance available just in case something happens to you. And the remaining balance of the money in your cash accumulation account can be used to fund your retirement, your business, or whatever you want to use it for. It's super flexible. Just like when you have a 401k, 457 TSP, SF, IRA, or whatever, that money can be used to fund businesses. It can fund, home owning projects. A lot of people like flipping houses these days, but they have a tough time finding revenue to be able to do so. Just use the money that's in your IUL. Now, I will say this. A 529, an IUL, 401k, and various retirement plans. These are long-term cash accumulation options, long-term investment options. It is essential that you appreciate that fact. That way you know that you'll have that money growing and available for you when you need it. I hope this was helpful, and I look forward to talking to you all soon. Take care.